Hello, and welcome to session 3. We're going to be looking at it a little later at managing an uncertain future in manufacturing, something we've kind of learned a fair bit about over the last couple of hours. Before we start that session, I'd like to introduce Henner Lehne, he's Vice President for Global Vehicle Forecasting Automotive at S&P Global Mobility. He manages the global vehicle and sales and production forecast services and leads a team of analysts around the world's key automotive regions. And since December 2011, he's also managed the global vehicle production team. So some great insight into production operations. Henner is going to do a forecast presentation for us for about 20 minutes. And then I shall bring on 2 more guests and we'll have a discussion around the challenges of manufacturing and future plans. So, Henner, could I invite you to the screen, onto the stage, please? Thank you.
Very good. Thank you, Nick. So, I got the honor to walk you a little bit through the state of the industry, how we see it right now. Lots of going on. Forecast outdated by the time it's released. It's very turbulent times. But on top of it, we're seeing a tipping point in automotive manufacturing globally, but also in Europe. We had some interesting discussions this morning already, which are leading to it. And I want to walk you through very quickly what our latest outlook is, what we see, where are some of the problem areas, and how this could play out longer term. So, just a cloud of buzzwords. We have lots of things going on in manufacturing. We have, of course, we had COVID, we had the chip crisis, then we have this year the new thing, the Russia-Ukraine crisis, which further disruption of supply chain, leading to a global economic crisis, high interest rates, high inflation, logistics still disrupted, a complete new relationship on how suppliers and OEMs are working together. Last-minute call-offs of volumes, nothing you can really count off anymore. Really, really turbulent and tricky times. On top of that, of all the problem side, there's major investments, and we heard it this morning, into battery plant capacities, into the electrification, new platforms, new projects. Since 2 years, we heard it earlier, there's a real drive. Everybody wants to be first to be 100% electrified, at least in Europe. And even in the US, it's taking on right now with the Biden administration, the IRA legislation put into place. So lots of things going on, affecting, of course, the world. We knew it 3-4 years ago, before COVID came and pretty much that street started, we're on now. One of the key areas, which is of course important for manufacturing, is of course raw material prices and also then the sentiment. And what we are doing together with JP Morgan, we are tracking the so-called Purchasing Manager Index. And with that, you can get an indication on how the sentiment is in the industry. And what you can see at the 50 mark pretty much above it means expansion. If it's below, it means contraction. And you can see we're continuously with COVID, where we had a little bit of a rebound, everything opened up, everyone was cheerful, and then semiconductor crisis, it's on a global area, declining quite significantly. And even in the markets, right? There's not a single market really which is not pointing down. We had a little bit of upstream in China, now it's down again. Japan is holding up the best, I would say, at the moment, but Eurozone, United States also clearly below the expansion mark. And of course, this is just an index, it's which we're having, but it's a good first indicator of the sentiment of the industry and what's going on, because in the end, it's querying thousands of managers and industry experts across various areas. Raw materials, very tricky. We are seeing, if you compare it to 2010, after the Lehman Brothers crisis, where we had another commodity super cycle, we are in another cycle, and actually it is even higher and even worse than what we saw after Lehman Brothers. especially in the area of chemicals, but also raw materials, energy. We talked about it this morning. And it's coming off now slightly. So we saw a decline in the last quarters of around about 25%. But we believe we hit bottom now. So it's not going to come down much further. So if you would compare it to 15, 16, 20, we are running at a much higher level for material prices that we had before. And that is, of course, for manufacturing, given the environment which I described before with all the other things going on, one of the key issues you have to deal with. And we heard it this morning with the battery costs, right? We need to cut costs. Very difficult at this point in time. And of course, a complete different mixed picture. Another, of course, very important input is oil on the one side. If I would have stood here a year or 2 years ago and would have told you about the $100 oil per barrel mark, you would have not believed me. Guess what? We reached it. We're coming down of it. A lot of it is, of course, fear factors. It's a fear premium which is baked into it. But oil, given the situation we're in, with the situation, especially in Russia, we are running at a much higher oil price cost. Of course, you could say, hey, this is now a good reason to go even faster into the electric vehicle offerings. But it's not that easy, right? Oil is used for other things, for plastics application and so on. It's not just the end consumer who might see a higher price at the pump. On the other hand, and this is a real problem, what you can see on the right-hand side, is the gas price. And TTF is the European gas price, Henry Hub is the US one. And just to give you a comparison how far apart it is, the European gas price at the moment for manufacturing, and you need that, of course, as an input if you're a chemicals company, but also just to use it for generating electricity and various other processes, we are 28% higher in Europe for the gas price versus what you have in the US. And I think you don't need to be a genius to figure out this is a severe problem. And going forward, this is actually not going to get much better. There will be a slight decline. There are new resources coming online. For example, in Germany, we saw it with the LFP deals coming in from Middle East. But it's going to be a major, major disadvantage for the European production environment to stay at these high gas prices, either because you have to pay it or you have to invest a lot of money to get rid of fossil fuel and then try to source energy maybe via hydrogen or via alternative clean resources to power your business. Or in last consequence, you will just leave the market and produce there where it's cheaper. And this, in the end, what we see this year, and I want to look at the left chart first, resulted in the largest forecast reduction we have done since I'm doing this, and I'm in this business since 2005, looking at forecasting out. And this is just from January to October. So the orange line is our January demand forecast before we had the Ukraine crisis and the chain of events taking place. And the blue line is our October forecast. And you can see we nearly took 60 million units out over the forecast horizon in light vehicle demand. At the moment, the demand is taken out because there's not enough supply. And longer term, and this is what you can see on the right chart, it will be taken out by pure demand destruction, by higher costs, by the destruction of economic capacity, which leads to this point where we're nearly taking a full crisis year out. Again, looking at what I said at the beginning, a lot of investment took place, not just in COVID, to recover through COVID and to make it somehow through there, but before, right? The electrification, the change of the industry, environmental standards, there's a lot of going on, or investment going on, which is impacted of demand not following. You could say, hey, good news is the market is still going to grow next year. Yes, it's going to grow, but it's a shadow of itself. Originally, we're talking about a 95 million market at peak times, and at the moment, we won't reach 85. So it's 10 million below, 10 million vehicles you cannot sell, and then we pretty much refinance the investments you have and have an income for the much higher cost base you're operating in. And if you want to look at the details, of course, supply chain losses at the moment is still the #1 driver. Despite everything going on, and you see the shock news about high electricity bills and gas bills and so on, at the moment, the reduction in demand is purely supply-driven. We have certain pockets in the US, for example, on frame vehicles, SUVs, pickups, where you can see a little bit of inventory building up. In China, a little bit of inventory building, but in general, it's still the availability of vehicles. And even on the numbers we're seeing here, we're around about seeing 82 million vehicles being built. We're currently trying to understand how many of those are actually finished built, because they're reported to be built, but there's still a lot of indication that a lot of unfinished vehicles standing around on the parking lots of this world, where you still have to fit a navigation module or sound module or some other things into it. So supply constraint is at the moment still the #1 constraint. Of course, we also have to be fair. We took 1.7 million, or Russia was 1.7 million units. The forecast theoretically could be up to 3.5 million units. We pretty much had to take that out as well. So this is also included in the 58 million we had to take out. We're running Russia at the moment around 700,000 units, minimal maintenance mode, how we call it. And we run it through like that through the end of the forecast horizon, because who knows how this situation is going to end. So we pretty much, it's more like a placeholder demand, minimum maintenance, which is also, of course, going into it, but it's not the majority of the volume destructed. And yeah, the majority, as you can see on the right side with the light blue, the sales profile, the demand destruction is really destruction from demand, from people just not being able to afford a vehicle anymore or not having the economic condition. Because one thing we can see clearly, vehicles are getting more expensive and expensive. The OEMs were having a good life last year, the year before, very high prices, high margins, while the suppliers were struggling because they couldn't really monetize a lot of them on the high option vehicles which got offered only. Because if you have limited supply, you of course want to sell what has the highest margin. And this is going to change now because there are not that many entry vehicles available anymore. We hear news like Fiesta going to be stopped, lots of pullout of smaller segments. With the electrification in general, with the high costs which we're seeing, for example, on raw materials, but also cost on the traditional sector like Euro 7, how much is that going to add to the vehicle? The vehicles will become more and more expensive and pretty much wiping out the lower segments more drastically, more faster than anticipated earlier without this economic crisis we're in. So a lot of volume is really destroyed, starting from 24, 25 onwards. So what we call demand destruction, because economic conditions just shifted significantly. And at the moment, it's not, especially for lower and mid incomes, the time to replace a vehicle. And there's a lot of uncertainty as well, right? Should I still buy an ICE? Should I already wait for an electric vehicle? Can I get one? At what price? Should I still need a car at all, or do I go with another offering? So this is all also what plays in there to that demand destruction, which is pretty much the tipping point, not only for the European, but for the global industry we're all working in. If we're looking by regions, we indexed the regional production at 2017 as our starting point, where the world was still good. And what you actually can see, there will be only 4 regions which are back on a growth path. So we have India, we have the ASEAN regions, we have South America and mainland China back on a growth path, and all the mature markets, taking Russia, CIS out of it because of the situation I described before, are actually coming in lower than at what levels they originally operated in. North America is still the best in recovery. There we see some shifts from Canada, US, Mexico, so there's some movement going on. IRA needs to, of course, now be fully analyzed, what maybe onshoring that will trigger. There are various discussions how that could happen, but nobody, or besides a few, not many have made a decision yet how to react to it. But yeah, in Europe, clearly the signs is are set to declining volumes in the long run because, for example, a lot of the electric vehicles in the mid-segments will be brought in by China. Of course, the European Union now is looking at it, said, okay, the Americans have IRA, how can we benefit, or do we need our own IRA, right? Some would call it the Anti-China Act. That is also still TBD and could change this, but at the moment, how things are standing, Europe will have a long-term decline in volume, in manufacturing volume, less exports, more imports, and are resulting that we're not reaching 2017 levels again. And some might call it we're reaching peak car, or have reached peak car in the mature markets already. On Europe, just to give you an idea how that could look like, the historical peak in 2017 was 20.6 million units. So this is maximum output, and we're taking Russia CIS out of the equation again. Then we had our pre-COVID forecast where we said, okay, 99, still slight reductions, but everything's still good. Then came the chip crisis. Until 2025, we're already down to 18.5. Then the pre-Ukraine crisis forecast, 19.2, where we saw a recovery. And then the current forecast, we're only coming in by 2025 at 16.8 million, which is around about a 4 million unit reduction to what originally was. And this shows also how quickly, within 3 years, a whole landscape is shifting, which we're operating in, and also what that means on flexibility, manufacturing, but also on your cost basis, right? Which is in the end one of the critical topics. This is what I said in regards to the problems Europe has in regards to exports and imports. Exports will be reduced, more onshoring, and again, this does not include IRA yet. So we will have to see what that will mean in the long run for localizing further production in the US. For example, Stellantis, some of their electric vehicles for the North American market were supposed to be built in Europe and then shipped over. With IRA, this becomes quite expensive depending on where you compete. It's not just the $7,500 on the initial vehicle incentive on the battery and the raw materials, but there's another credit available for building green technology, which could be up to another $4,500. So you could have a price difference on $12,000 just from the start. And therefore, Stellantis, for example, will have to see how do they react to IRA, how much will they bring onshore, and Stellantis, of course, trying to work with Europe as one of the sourcing hubs, being European-led now. This is something which we expect to come, but we don't know yet how that will look like. And this will definitely drive the export number even further down. On the other hand, imports, this is on the one hand, we're still cautious on the Chinese brands coming into the market. There is better potential than ever in order to win market share. We see a couple good examples. We all heard about the 6th BYD deal. We know the first NIO is driving around here, and Lincoln Co. also quite impressive. And they're more and more lining themselves up to come. In the end, we will see really will they get to the tipping point that they can get critical mass or not. So this is something we're still evaluating. But the environment is clearly there to fill a gap, also especially at the lower, cheaper segments. But also a lot of the established manufacturers are producing in China to chip back, right? Smart, Mini, bringing the vehicles from China back into Europe, which is then having a higher import rate than we saw before. How is production going to change in general? One thing certain people might not like, left chart, it's going to be more SUVs or CUVs or SUV-like vehicles. SUV is king, and you can complain about it as much as you want. It's going to be even growing further. This is what people want to drive, especially in electrification with the higher space you need for the battery packs. And it's not really SUVs, like taller vehicles, let's call it like that. Is one of the areas of focus. And in the power, and if you look by powertrain, of course, the battery electric vehicle will take a big chunk of the conventional manufacturing volumes by 2030. If you look at it, 2035, EU Commission wants to ban the sale of ICE vehicles. Even plug-ins will not be allowed. So this is the first step into that direction. There will be niche operations in the ICE segment still remaining, but we're clearly in Europe from a manufacturing footprint onto an ICE plant. I should have showed you this in percentages because the question is not, in my view, will we get to 100%? The question will be, what is the volume behind it? So this is at the moment our volume we see, but we heard it. If it's we see problems in ramping up battery capacities, all these plans of battery plants which are announced, of course, The volume could be less, or the consumer doesn't follow, is of course another thing. Will Ford, who wants to switch to 100% BEV by 2030 in Europe, really still sell 1.4 million, or will it be just 800,000? There will be 100% BEV, but at what volume? So that's another game which still has to be played out yet and to be decided, and it's too early to make a final commitment on that. But yeah, BEV on the BEV road on the right chart, what you can see also, and this is actually the irony, a lot of these activities we see in the electrification space are to have a better environment, to be more urban friendly. But what's happening actually, the AV is kicking out the A and B segments. The smaller cars are all going to die. We will have on the panel later somebody who's trying to fight against it with their offerings. But normally, if you see it, everybody's pulling out the smaller segments because it's very hard to make money in these segments. And it's actually the irony. The cars are actually getting much bigger and bigger. On the one hand, range anxiety, bigger packs, what we heard earlier. But yeah, also the cost, right, and the return on investment. Can I really build a 12, 13, 14,000 euro longer range B segment car at a sufficient cost base? At the moment, it doesn't look like it. Otherwise, the OEMs, the large ones, wouldn't be pulling out en masse out of these segments. And my last slide, just to kind of show you reality, which is already known, right? We have a shift of production already. So the red plants are the ones which are ending production. We have JLR, Renault, Ford, Saarlouis, Ludwigsfelde for Mercedes. On the other hand, we have a couple plants at risk, right? Ford Valencia, who knows what's going to happen there? Stellantis Madrid, VDL, Novo Mesto, and Suzuki in Estrogen. But we are also seeing more and more investment into new BEV operations. We heard it this morning, right? Hungary, the plant ambition there, but also Mercedes, Javor with Rivian building the transporter there. Porsche Leipzig is building up. Tesla, of course, first iteration, they're going to add more capacity as further in Berlin, even though they're pulling now due to IRA, most likely the battery manufacturing out to bring it onshore into the US. And the same with VW. So we see a shift, unfortunately, more deletes than adds, but it's still holding itself to a certain degree in the balance. But of course, from a regional footprint, if you have national governments, then this might be bad news to you, depending on where you sit and how you need to serve your voters. And with that, I'm done and looking forward to the panel. Afterwards, we have some Q&A.
Thanks, Henner. Do you want to take a seat and I'll just bring on...